Assalamualaikum warahmatullahi wabarakatuh. My name is Wan Muhammad Shawal bin Wan Uthman. My metric number is A2382385. Today, I will list about an overview from this all content presentation. The first one is introduction of Tiangnam Logistic Holding. The second one is ratio analysis of Tiangnam Logistic Holding. The third one is recommendation for Tiangnam Logistic Holding to improve their organization. The fourth one is sources of fund for company Tiangnam Logistic Holding Berhad to expand its business. The fifth is introduction of straight energy resources Berhad. The sixth is ratio analysis of straight energy resources Berhad. For number seven is recommendation for straight energy resources Berhad to improve their organization. And the last one is sources of fund for company straight energy resources to expand its business. Thank you.
Hi doctor, my name is Amaran son of Rajendran and my matrix number is A23B1308. Today I would like to present about the introduction of Gyeongnam Holding Berhad. Gyeongnam was founded by Mr. Yong Myung Ong in the year 1975 at the Johor Bahru, Malaysia. Besides that, Gyeongnam Logistic Holding Berhad is a Malaysia-based investment holding company engaged in the provisions of fully integrated logistic and warehousing services in the Asia-Pacific region. Gyeongnam was established itself as a key player in the Malaysia and overseas for several decades. It operates four segments, namely logistic and warehousing services, which is the key revenue driver, investment, property development, and also hotel dormitory. My second point is about mission and vision of Gyeongnam. Starting from mission, expand industry presence into key markets such as Singapore and Thailand to better serve the growing customer base. The company strategically expand operations throughout South Asia while maintaining a strong presence in Malaysia. Now, we are moving to vision. They have commitment to sustainability, proactively adopting eco-friendly practices such as fuel-efficient vehicles, optimized roads, and green warehouse program. Technology integration is embracing cutting-edge logistics software and system for improved efficiency, transparency, and real-time tracking. Moreover, the corporate social responsibility CSR is dedicated to giving back through community development, environmental conservation, and charitable contribution. My third point is about services that provided by Gyeongnam, starting with transportation and freight management, reliable domestic and cross-border services for various industries. Second is warehousing modern facilities with efficient inventory management system. Third is distribution specialization in timely and secure delivery, including last mile services. Next, freight forwarding comprehensive, air, sea, and land solution tailored to client. Besides that, custom clearance, smooth navigation of complex regulations for hassle-free shipment. Furthermore, supply chain solution integrated planning, procurement, and distribution management. In additionally, value-added services such as packing, labeling, kitting, and assembly for improved efficiency. The e-commerce fulfillment specialized services including order fulfillment and last mile delivery. Moreover, project cargo handling expert handling of oversized or heavy cargo with meticulous planning. Last but not least, cold chain logistics is a temperature control storage and transportation for perishable goods. Thank you. I pass to next presenter.
My special greetings to Doctor. My name is Santana Tanisha, daughter of Xavier Rajadurai, and my matrix ID is A2382400. Today, I would like to present about the ratio analysis and calculation based on Tiona Logistic Holding Annual Report. The main is liquidity ratio. Number one, quick ratio. In 2021, Tiongnan Company quick ratio was RM0.67. It grew to 2.71 in 2022, indicating a strong liquidity position, most likely due to better cash flow or asset management. Moreover, a sudden decrease to 1.11 in 2023 indicates poorly cash flow concern as a company present assets were insufficient to meet its short-term liabilities. This reduction could be related to recent capital-intensive expansions, emphasizing the importance of wise cash management avoid liquidity issue. The second ratio is current ratio. Vietnam's current ratio have increased significantly from RM 3,155 in 2023 to RM 24,606 in 2022, almost increasing to RM 49,772 by 2021. Vietnam has steadily increased its current ratio. This strong gain in liquidity may position Vietnam well for future investment, but it should continue to manage assets to ensure its optimal result. The third ratio is account receivable. Vietnam account receivable have shown a concerning decline, which is from RM negative 4.08 2023 to RM negative 11.74 in 2022 and RM negative 18.95 in 2021. This growing negative balance signals potentially credit management issues or challenges in collecting payments from customers, leading to a larger proportion in unpaid invoices. The fourth ratio is inventory turnover. Vietnam ratio analysis shows that a sharp rise in 2023, which is RM 1,434 ringgit and 3 cents to RM 1,636 ringgit to 2 cents. In 2022, strong inventory movement, which is improving cash flow and reducing holding cost. It is declined in 2021 to RM 2.54 shows slow inventory turnover, indicating potential issue with strong management, higher storage cost, and outdated inventory. So that Vietnam should align inventory practices which market demand to optimize turnover and minimize cost. Moreover, there is a capital structure ratio of Vietnam Logistic Holdings annual report to capture the debt ratio that the companies have. The first is debt ratio. Vietnam's debt ratio dropped from 0.623 in 2021 to 0.07 in 2022 and 0.09 in 2023. In 2023, improving its financial health, the high 2021 ratio raised concern, but the decrease reflects a more cautious approach, reducing interest costs and increasing reliance. However, this low debt level may limit growth potential. The second ratio under capital structure ratio is asset management ratio. Vietnam's debt ratio rose from 0.28 in 2021, 1.63 in 2022, and 1.7 in 2023. In 2023, indicating a heavy reliance on debt, this sharp increase suggests financial risk, particularly during high interest rates or economic downturns, while the low in 2021 ratio show a more stable financial position, which is the rising debt could lead to higher interest costs, liquidity issues, and reduced financial flexibility. Thank you. I will pass it to my friend.
My special greetings to Doctor. My name is Omaranjini, daughter of Periannan. My metric number is 8238239. First of all, I'm going to talk about times interest earn ratio. The times interest earn ratio shows how well Vietnam can cover its interest expenses using operating income. In 2021, the ratio was 0.80, increasing to 1.23 in 2022, indicating higher dependence on debt. However, in 2023, it dropped to 0.68, suggesting the company reduced its debt usage. This improvement lowers financial risk, enhances stability, and strengthens Vietnam's position for long-term growth. Secondly, fixed asset turnover ratio. The fixed asset turnover ratio measures how efficiently Vietnam uses its fixed asset to generate revenue. It rose from 430.1 in 2021 to 610.5 in 2022, indicating improved asset utilization. However, it slightly declined to 561.7 in 2023, reflecting a minor slowdown. Despite this, the overall rising trend highlights efficient management of fixed assets, contributing positively to revenue growth. The third one was operating profit margin. The operating profit margin reflects how efficiently Tiongnan earns profit from its operation. It improved slightly from 0.06 in 2021 to 0.07 in 2022, but declined to 0.043 in 2023. This drop indicates rising expenses or slower revenue growth. Improving cost management and operation efficiency will be critical for enhancing profitability. After that, gross profit margin. The gross profit margin measures how much revenue remains after dedicating the cost of goods sold. It has declined significantly from 0.18 in 2021 to 0.03 in 2022 and further to 0.02 in 2023. This suggests increased production cost or pricing pressures. Managing costs effectively will be essential to improve profitability. Next one was net profit margin. The net profit margin shows how much profit remains after all expenses. It's fluctuated with a significant increase to 7.54 in 2022, likely due to on-time gains, before falling to 0.04 in 2023. This instability points to challenges in managing expenses or financial pressures requiring careful cost control for sustainable growth. Lastly, about operating returns on asset. Operating return on asset measure how efficiently Tionam used its asset to generate operating income. The ratio was 1.65 in 2021, dropped significantly to 0.11 in 2022, and improved dramatically to 7.16 in 2023. This strong rebound highlights efficient asset utilizations and improved profitability in 2023, a positive sign for the company's performance. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Wan Muhammad Shawal bin Manatman. My metric number is A23A2385. I will continue presentation about market value ratio. Market value ratio is a financial tool that helps investors understand how the market values a company compared to its financial performance. Jiangnan financial performance over the year showed some fluctuation. In 2023, the company performed well with a ratio of 5.42 and a total of 514,047,000 ringgit Malaysia, indicating strong efficiency. However, in 2022, the ratio dropped to 1.01, suggesting a significant decline in performance despite the total staying similar at 514,048,000 ringgit Malaysia. In 2021, the ratio was 2.42, which was an improvement over 2022, but still lower than in 2023. Overall, Tiongnan saw a peak in performance in 2023, a dip in 2022, a moderated performance in 2021. That's all from me. Thank you.
I will continue with the next part, which is recommendation for Journal Logistic Holding Berhad to improve their organization. First, Journal should strengthen its cash flow management. For account receivable, implementing automatic invoicing, stricter payment terms, and offering early payment incentive can reduce overdue accounts. Regarding debt management, the company should aim to reduce its debt asset ratio by financing at low interest rates and retaining more earnings to decrease reliance on external financing. Next, optimizing inventory management is essential. Improving inventory turnover through advanced forecasting and demand planning can align stock levels with actual demand, reducing excess inventory and holding costs. Additionally, adopting just-in-time practices will minimize storage costs and improve cash flow efficiency. To enhance profit margins, Journal should focus on cost management by adopting better procurement strategies, technology investments, and cost-cutting measures. Another opportunity lies in offering value-added services such as packaging and labeling to command premium pricing and improve margins. The next is diversifying revenue stream is another critical step. Expanding e-commerce fulfillment services and focusing on last-mile delivery will help tap into the growing online shopping market. Strengthening cold chain logistics for temperature-sensitive goods and expanding into specialized freight services like Project Cargo will create new revenue opportunities. Another recommendation is invest in technology and innovation. Investing in technology can significantly boost operational efficiency. Adopting advanced logistics technologies such as automated warehouse management, IoT sensors, and AI will optimize inventory and delivery process. Additionally, using data analytics for demand forecasting and route optimization can improve decision-making and reduce costs. Next is to strengthen customer relationship. Journal should improve proactive customer service by anticipating needs and providing real-time delivery updates. On financial risk management, it closely monitoring the debt-to-equity ratio and conducting regular updates will help Journal identify and address vulnerabilities early. Maintaining a balance between leveraging capital and managing financial risk is crucial, especially during economic uncertainty. Next is strategic expansion. Strategic expansion into emerging Southeast Asian markets present a great opportunity. Cross-border operation and partnerships with smaller logistic firms can accelerate growth. Collaboration with technology providers will also improve specialized service offerings. Lastly, strengthening corporate governance and compliance will enhance transparency and build investor confidence. Developing a robust risk management framework will also prepare Cheongnam for external challenges, ensuring sustainable growth.
Next, for Part C, which is Jeonnam Company Logistics, a prominent logistics and warehousing service provider in Malaysia, is poised for expansion for the operation. This ambitious goal requires a carefully considered approach to funding, as each source has its own unique strengths and weaknesses. To achieve its expansion goals, the company should carefully consider various funding sources, each with its own advantage and disadvantage. The company should explore a range of options, including internal resources, external debt financing, equity financing, and government grants and incentives, to determine the most suitable mix for its strategic objectives. Firstly, internal funding, which is company retained earnings reflecting the company's strong profitability and history of reinvestment, provide a solid foundation for expansion. Additionally, selling non-core assets such as land or property can generate immediate cash for growth initiatives. Secondly, sources of funds for company Tiongnan is external debt financing, which is Jeonnam's strong credit history and proven track record position is favorable for bank loans, providing flexibility in terms of loan terms and interest rates. Next, bonds, on the other hand, allow the company to access a wider investor pool and diversify its funding sources. Other than that, equity financing, which is right issues, allowing existing shareholders to purchase additional shares at a discounted price, can be a cost-effective way to raise capital without diluting existing shareholder value. Next, private placements, involving the sale of shares to a select group of investors, offer a faster and more efficient route to capital but may come with restrictions on share trading. Lastly, government grants and incentives. Vietnam could explore infrastructure grants, particularly for its warehouse construction projects, which could significantly reduce the cost of expansion.
Hello, my name is Nazura Wahida Betty Nazri. The matric number is A23A1546. Okay, I will explain about the introduction for the company is Trade Energy Resources Berhad. The founder for this company is Datuk Sri Hom Kai Choi. He has played a key role in the company's development, especially in the marine transport and oil logistics sector in Malaysia. The main business for this company manufacturing and marketing of water filtering and clean room products. Next, product expansion. The company has expanded its products to include fast-moving consumer goods (FMCG). FMCG consists of daily use products with a high turnover rate. Next, about the company background. Formerly known as Trade Interlogistics Berhad, operates in various sectors including oil trading, transportation, shipping service, port operation and port management. Next, about the strategy partnership. Establish a partnership with Tupuan Megah Development Sdn Berhad, a company skilled in dragging and bunkering vessels. This collaboration aims to strengthen the company's position in the bunkering industry. And for the last, about this company, strategy and goals. Reduce the risk of reliance on a single business sector. Expand investment into more profitable energy and maritime logistics sector, and strengthen its position in the energy and maritime logistics market. Next, about the mission and vision for this company. First mission, deliver quality products and service in water filtration and oil bunkering that meet customer and industry standard. Second, strength financial stability through a diversification strategy involving the revenue, FMCG, and energy sector. Last, optimize shareholders' return with a business strategy aimed at enhancing the company's value. Next, about the vision for this company. Lead the water and energy refining industry in Malaysia and the region. Provide high quality innovative products and service. Ensure returns to shareholders. Contributing the development of the energy and marine industry. Okay, last, the main purpose of establishing Trade Energy Resources Berhad. First, the maritime logistics industry is enhancing the role of logistics. Trade Energy Resources Berhad aims to lead in bunkering service and maritime logistics by ensuring efficient and cost-effective ship refueling at major ports to improve port operation and reduce downtime. Second, source of income through oil trade. The company plans to diversify into oil trading, including crude oil and diesel, to control part of the full supply chain, boost profit margin, and reduce dependence on one income source, establishing itself as a reliable supply in the shipping and oil and gas industry. Next, supporting sustainability through investment in clean energy. The company is investing in renewable energy like solar and biodiesel to reduce its carbon footprint and support the transition to cleaner, eco-friendly energy. And the last point is improving infrastructure and operational capacity. The goal is to boost operational capacity, ensure stable food supply, and provide better, reliable logistics service for the shipping sector. Thank you.
Hello, my name is Nur Alisa Maisara binti Nur Rashidi. My matrix number is A23A2163. So I'm gonna present about ratio analysis and calculation based on the Straits Energy Resource Berhad's annual report. Okay, A is profitability ratios. 1. Returns on equity, ROE. 2023 is 2.08, 2022 is 4.38, and 2021 is 4.46. For 2021, the ROE was approximately 4.46%, reflecting moderate profitability from its operation relative to equity. For 2022, it's declined to about 4.38, suggesting reduced profitability or increased equity levels during that period. And 2023, the ROE future dropped to 2.08%, indicating challenge in generating returns on shareholder investment despite operational expansions, particularly into telecommunications and network service. Okay, next is returns on asset, ROA. In 2023 is 0.61. 2022 is 1.030, and 2021 is 1.32. The values indicate relatively consistent performance over the years. There was a slight dip in 2023 compared to the previous year. This suggests a steady level of efficiency in utilizing assets to generate earning. And the last one is, however, the efficiency level is not exceptionally high during this period. Next ratio analysis is liquidity ratios. One current ratio, 2023 is 0.81, 2022 is 0.79, 2021 is 0.88. In 2021, the current ratio was approximately 0.88, reflecting the company's ability to meet its short-term obligations with its current assets. 2022, the current ratio slightly declined to around 0.79, indicating a marginal reduction in liquidity compared to the prior year. In 2023, the current ratio improved to approximately 0.81, showing a strange liquidity position despite fluctuation in revenue due to lower global oil price and diversification into telecommunication service. Next is quick ratio. In 2023 is 0.63, in 2022 is 0.62, in 2021 is 0.49. The quick ratios for streets energy resource Berhad over the last 3 years indicate a modest liquidity position. In 2021, the quick ratio was 0.63, signaling limited coverage of short-term liabilities with liquid assets. Similar levels were observed in 2022 and 2023, with minor fluctuations. The quick ratio consistently stayed below 1, highlighting potential challenges in meeting immediate financial obligations without relying on inventory. Next, ratio analysis and calculation based on the Straits Energy Resource Berhad's annual report is leverage ratios. Number one is debt to equity ratios. In 2023 is 2.42. In 2022 is 2.02, and in 2021 is 2.42. 2021, the debt-to-equity ratio stood at 2.242, indicating that the company had Rm 2.42 in liabilities for every Rm 1 ringgit of equity. In 2022, the ratio decreased to 2.02, suggesting a relative improvement in the company's leverage position with a higher proportion of equity financing. Last is in 2023, the ratio returned to 2.42, reflecting an increase in liability relative to equity, which may warrant further analysis to understand the underlying factors. Next is debt to EBITDA ratio. In 2023 is 11.18. In 2022 is 5.36, and 2021 is 6.7. In 2021, ratio of 6.7 indicating high debt relative to earnings. In 2022, improved to 5.36, reflecting reduced debt or increased earnings. And in 2023 increased sharply to 11.18, suggesting a significant rise in debt with only a modest increase in EBITDA, pointing to highest financing risk. The last but not least, the ratio analysis and calculation based on the Straits Energy Resource Berhad's annual report is efficiency ratios. This is a asset turnover in 2023 is 4.8, and 2022 is 6.45. In 2021 is 2.95. In 2023, it declined from 2022's ratios 6.45, indicating reduced efficiency or performance compared to the previous year. This could result from slower growth in the numerator or a disproportionate rise in the denominator. In 2022, the highest ratio over the 3 years, reflecting peak efficiency or performance and effective resource or obligation management. And the last one is 2021, the lowest ratio, highlighting weaker performance or higher costs or liabilities compared to assets or revenue. Thank you.
Assalamualaikum warahmatullahi wabarakatuh. My name is Tania Umaira binti Muhammad Azani. My metric number is A2382410. Today I want to present about recommendation for the Strip Company Limited to improve their organization. Firstly, improving corporate governance. The board of directors should maintain its independence and function as an efficient oversight body. Two is diversive and strong investment portfolio, such as investment in technology, renewable energy, and healthcare. Recommendation 3 is make an investment in ESG integration. A strong sound governance across social responsibility and lowering carbon emission are all part of this. ESG is ESG is economy, social, and green. So, for ESG, many benefit we can take for the ESG program because mm, like we can save our earth. For generation 4 is use technology to increase productivity. For example, in digital transformation and automation analytics. So I want to continue my presentation about recommendation for the Street Trendy Company Limited to improve their organization. For five recommendation is pay attention to employee engagement and development. For example, invest in throughout training and development initiative. Secondly, pay attention on positive work culture. For recommendation 6A boost global presence. For example, strategic relationship, market research, find possible market for growth by doing indeed market. For recommendation 7 is trade and adjust to market trend, market intelligence. To remain flexible and sensitive to shift in the economy and market trend, set out a strong market intelligence system. Another example is scenario planning.
Assalamualaikum and hi, my name is Nur Shafika Betty Marazi. The number matric A23A1693. I will be continue the slide about the company's trade energy resources Berhad is planning to expand its business. Please advise the company on the source of funds that is most suitable to meet their objective. Straight Energy Resources plans to expand into a new market and boost production. Proper funding choice like a debt or equity ensure growth while minimizing risks. The first is debt financing through loans and bonds. Bank loans. Straight Energy can leverage flexible loans from RHB and Maybank. Corporate bond. Straight Energy can issue bonds to raise capital without equity dilution. 2. Government grants or subsidies. Government grants fund innovation without repayment but needs competitive application. 4. About equity financing. Equity financing offers funds and expertise, but it is costly. It both funds and credibility. Last not least, internal financing. Internal financing uses saving for growth, ensuring stability and flexibility, but may reduce dividends. 4. About equity financing. Equity financing offers funds and expertise, but it is costly. It both funds and credibility. Last not least, internal financing. Internal financing uses saving for growth, ensuring stability and flexibility, but may reduce dividends.